This module discusses the accounting information system and, more specifically, how transactions affect the accounting equation and end up on the financial statements. The accounting equation is the backbone of accounting, and it is assets equals liabilities plus owner's equity. So, how does that fit within an accounting system? Accounting information systems collect information from transactions. The information is processed and transactions are recorded through double entry accounting. That means there's at least one debit and one credit, and the accounting equation is balanced within each transaction. We'll talk more about debits and credits later, but for now, just know that debit means left and credit means right. After the transactions are recorded, the information is organized into the financial statements, and that's communicated to the decision makers. Factors that affect the accounting information system include the nature of the company's business, the type of transactions, the company size, volume of data, information demands of management, as well as others. And most businesses use computerized accounting systems, sometimes referred to as electronic data processing systems. Transactions themselves are economic events that require recording in the financial statements. Transactions occur when assets, liabilities, or stockholder equity items change as a result due to an economic event. But not all activities represent transactions. For example, putting a bid out for a potential job is an activity, but not a transaction. Accounting transactions occur when assets, liabilities, or stockholders' equity items change as a result due to the economic event. And transactions can be internal or external to the company. An external event can be the purchase of equipment, payment of rent, payment of utilities, payment of salaries, and wages. Examples of internal events include the cost of the supplies used by one department, or the cost of buildings and equipment as they are depreciated. Analyzing transactions, or transaction analysis, is the process of identifying the specific effects of an economic event on the accounting equation. The accounting equation must always balance. Sometimes you will hear people say that the transactions have a dual effect on the equation. What that means is there are at least two accounts affected. So if one specific asset is increased, then there must be a corresponding decrease in another asset, or increase in a specific liability, or increase in the stockholder's equity account. There can also be a mix of accounts affected, as long as there are at least two accounts affected. I'll show this in an example in a minute, but let me restate the basic accounting equation is the fundamental building block for accounting, and it is assets equals liabilities plus owner's equity. And I often say that owner's equity really consists of two different pieces. Owner's equity consists of the ownership piece and the income piece. Technically, the ownership piece is called contributed capital, and the income piece is called retained earnings. Expanding it even more, the contributed capital is common stock and additional paid-in capital, but that's for a much later module. Retained earnings is the earnings retained in the business. Retained earnings no longer has dividends held within it, and that is why it's subtracted. It's removed from retained earnings. Remember, dividends are not an expense, but the prior earnings are given to the owners. Now, of course, the earnings themselves are revenue less expenses. That comes out to the income that's retained in the business. For our example, we'll use these accounts in this expanded equation. I suggest you create columns on a spreadsheet and follow along. But here's the accounting equation. Here are your assets. Here is your liability, and here is your owner's equity. So we have an equal sign to show the accounting equation between the assets and the liabilities plus owner's equity. In transaction 1, on January 1st, cash of $25,000 is invested in Sandy Corporation by investors in exchange for $25,000 of common stock. The asset cash is increased along with the owner's equity account common stock. You can see how they are put into the accounting equation. Note, the accounting equation holds. Both sides of the equation increased as assets increased $25,000 and owner's equity, the common stock account, increased $25,000. In transaction 2, the company borrows for $50,000. It's a loan from the bank with terms 3-month loan, 6% interest. We'll deal with the interest later, but the asset cash increased along with the liability account called notes payable. You can see how they are input into the accounting equation. Note, the accounting equation holds. Both sides of the equation increased as assets increased $50,000 and the liability, notes payable, increased $50,000. Now in transaction 3, the company purchased equipment costing $30,000 and paying $5,000 in cash and the rest on account. In accounting, we use the terms on account to represent an interest-free agreement. This can be an accounts receivable or an accounts payable, depending if the organization will be receiving cash or if it needs to pay cash. A second thing is happening in this transaction. It's not a simple one account increases and another account decreases. This is a compound transaction since the company paid some cash and the rest on account. The asset, equipment, increased $30,000 because that is what was paid for the equipment. The asset cash decreased $5,000 for the cash paid. That totals the left-hand side of the equation for $25,000. It also agrees with the right side of the equation and the accounts payable. You can also see how they're input into the accounting equation and that the equation holds. You can also see the decrease in cash is shown by putting the $5,000 in parentheses. This is the accounting notation for things being negative. So the negative $5,000 plus the positive $30,000 is how we arrive at the $25,000 for the left side of the equation. Note, the accounting equation holds. Both sides of the equation increased as the asset side increased $25,000 and the liability and equity side increased $25,000. In transaction 4, the company paid $1,200 for a 6-month insurance policy. Because insurance needs to be paid before you use it, and when canceled, the unused portion is refundable, the unused portion is an asset. Remember, an asset is a resource to be used by a company, and we call this asset prepaid insurance. When insurance is used by a company, we have an expense. And remember, an expense is a necessary outflow from the company as part of its operations. We'll call that expense insurance expense. When insurance is originally paid, we typically put the entire amount in prepaid insurance. Then, each month, we move a month's worth from the asset prepaid insurance to the insurance expense account. And we'll talk about that later as the insurance policy expires. The transaction we have now is the purchase of insurance. All transactions where assets are purchased for cash are the same. The asset increases while the asset cash decreases. You can see how they are input into the accounting equation. Note, the accounting equation holds even though the transactions are only on the left side or the asset debit side. The asset prepaid insurance increased $1,200 while the asset cash decreased $1,200. And the left side of the equation equals 0. That's also the total from the right side where no transactions are recorded. In transaction 5, the company is finally ready to start earning revenue. In this transaction, it performed services for $7,000 on account. In other words, the services were performed and the customers will pay soon. It doesn't matter if cash has changed hands yet. The work was done and the revenue was earned. Since the company will receive money from the customers, they have an accounts receivable. This account is an asset account, and that has increased. On the other side of the equation, revenue is earned. Remember, revenue is a portion of the income side of owner's equity, and the revenue account, service revenue, increases. Again, note the accounting equation holds. The opposite happens in transaction 6. Here, the company received $5,000 of cash in advance from a client. The cash was received, but the company owes the work to the client. Since they owe the work, it is unearned. This is a liability account called unearned service revenue. Don't let the term revenue trip you up. It is unearned. When the work is completed, it will be earned, and the company will no longer owe the client. So when it is completed, the liability called unearned service revenue will decrease, and the revenue account will increase. But now we are recording the receipt of cash. So the asset cash increases, and the liability unearned service revenue also increases. And note, the accounting equation holds. In transaction 7, the company received a bill for $1,000 in utilities and will pay within 30 days. The company is using electricity or other utilities every day, but they do not know the amount of the bill until it is received. Using the utilities is an expense or a cost of doing business, and the amount is owed, typically within 30 days. Since it isn't an official notes payable, it is an accounts payable. When it is received, the liability account, accounts payable, is increased. The expense, utility expense, is recorded. Expenses reduce income, so all expenses are subtracted from the revenues to arrive at net income. That's why the entire column of expenses has a negative sign in the equation. Because we don't have a lot of room in this example, all expenses are in the same column. But there is a notation on the side explaining the type of expense. I'll just use an icon to demonstrate utility expenses. And similar to when one asset increased and another asset decreased, the effect on the accounting equation is only on one side. There wasn't any change in the assets. But on the other side of the equation, the liability accounts payable increased, and the expense and its effect on income decreased. The total of the right side of the equation is 0. While some expenses, like utilities, need a bill to have the transactions recorded, some expenses are more obvious. Transaction 8 pays employees $3,000 for their work. In another module, we'll talk about the timing between the employees working and being paid. But for now, we'll say the work period concluded today and employees were paid in cash. We know that cash is an asset, so we see it decreased here. We also know that expenses reduce income and are shown as part of that reduction here as well. So the accounting equation holds with the negative $3,000 on the asset side of the equation and a negative $3,000 on the liability and owner's equity side of the equation. And remember, the icon to the right is to identify each of the different expenses. In transaction 9, the customer who owed $7,000 paid half of their bill. This is a simple asset exchange, and we've done that before. The asset cash increased, and the asset accounts receivable decreased by the exact same amount. The accounting equation holds with a total of 0 on each side of the equation. In transaction 10, the company paid the utility bill. Since the amount was already owed and recorded as accounts payable, both the asset cash decreased and the accounts payable decreased. As with all other transactions, the accounting equation holds. Remember when the company received $5,000 of cash in advance of the work being completed? Well, in transaction 11, 40% of the services paid in advance were completed. So the company no longer owes 40% of the work, and that liability has decreased. Likewise, revenue has been earned in the same amount. So 40% or $2,000 has been earned. The liability unearned service revenue has decreased, and the revenue account has increased, and the accounting equation still holds. At certain points during the year, management decides to give dividends. Here, it decided to give a dividend to owners of the stock. Transaction 12 is that dividend of $5,000 were paid. Dividends are not an expense, but they do reduce retained earnings in the owner's equity of the company. So the asset cash has decreased, and the owner's equity account, dividends, has decreased. And the accounting equation still holds. Here is a total of all the transactions. The purpose here is to show that the accounting equation holds. The real importance of this is to use it as a base for preparing journal entries. In another module, you'll see that increases to some accounts are debits, while increases to other accounts are credits. The same happens with decreases, and even in journal entries, the accounting equation always holds. Financial statements can be prepared from these accounts. Isolating the income statement accounts, you can see the total revenue of $9,000. The expenses should be listed separately, so it is important to know that $1,000 was from utility expense and $3,000 from salary expenses. The total expenses is $4,000, so the net income is $5,000. The underlining of net income is to highlight the purpose. The double underlining of net income is to highlight the purpose of the statement. The date of the statement is for the entire period covered. In this example, it's for the month of January. The statement of owner's equity is prepared next. If there was a prior balance in retained earnings, it would have been in a separate column. But we're starting a new company, so there isn't any retained earnings at the beginning, and the balance is 0. Then you add the net income from the income statement and subtract the dividends from this column. The amount remaining is the new balance in retained earnings. The double underline of the ending balance in retained earnings is to highlight the purpose of the statement. And the date of the statement is from the entire period covered. In this example, it's for the month of January. The final balance in the statement of retained earnings is carried to the balance sheet, along with the total for each asset, liability, and capital accounts. The double underline for the total assets and the total liabilities and owner's equity is to show the balance in the accounting equation. The date is not covering a period like the other financial statements. It is the balance of the assets, liabilities, and owner's equity as of the last day of the period. In this case, the last day of January. We will cover preparing the statement of cash flows in another module. So this completes the module analyzing transactions in the accounting equation. Please reach out and let me know if you have any questions.